In so many ways, it will affect the relationship with all these other people, because when you're talking stakeholders, the value of the firm is going to be greater simply because the firm is going to avoid and prevent many of the losses that otherwise would fall through the cracks and that they would have. That's number one for all the stakeholders in general. Number two is it's going to cause that reduction that we discussed in actual costs to the corporation, to the entity, because of the verification that can be documented to their own insurance providers. So not only is it going to help avoid and prevent losses by shifting them to others, but it's going to save them money because of their own insurance costs. And one other thing I want to say about that. A lot of people think that the only time when there's a problem with third parties insurance is if there's some nefarious endorsement, or that we call something like a prohibited or suspicious endorsement or something like that. And that's true, but it's not the only time. And let me give you an example of what I mean. Even under the standard ISO additional insured forms, as an example, there are certain things that must be complied with and required in the contract. And if it's not, even though you're named as an additional insured, you may not have coverage for a number of reasons. That contract may not be with you, it may be with the guy that hired you, and the additional insured endorsement just says that the additional insured is anyone you have a contract with, not a contract from the person who hired them. That's just one example. That's a standard thing in all of, in fact, that's in the most used automatic blanket type additional insured endorsement in the industry. What I just said is true, and many people have no clue that that's the case. Further on that is the requirements of all of the newer, and newer meaning after 2013, so for the last 10 years, all of the newer additional insured endorsements require that there actually be a requirement in the contract. Otherwise, it only pays up to what is required. Let me give you an example. It's better. You say we're going to say it's a small thing and we're going to require $1 or $2 million instead of 5 or 10 or 50 or 100, like some of these bigger cases. Well, if you require $1 million and the person you hire has $5 million, and then there's a $5 million claim, your contract said you required $1 million. So even though they have 5 million, guess how much is going to get paid to you and your stakeholders and going to protect your company is not the 5 million that the guy had that you hired, but instead it's going to be only the 1 million that you required. We have, as part of our language requirements, part of that triggering language that I've referred to previously that activates the coverage, we have language in there that allows us, even if there's a minimum requirement of insurance, it allows us to get the full amount of coverage, not just that's carried by this individual we're hiring, but even if other insurance is available to that person. And let me explain what I mean by that. They might have other additional insureds that are insuring them that add to their coverage. So instead of the 5 million in the example they have, they might have 5 subs with $1 million each. So really they have 10 million to cover that claim. Guess what? 100% of that $10 million is available to us because we've made that precise language in the contract for our company, for our stakeholders, to protect them, to protect their bottom line, and to transfer that money and that risk to others. So I know that's kind of a long roundabout answer, but at least it gives you a realistic, and once again, I want to emphasize that example I just gave is with standard, not these off-brand or not the weird ones. That's with the standard preferred ISO endorsements. People don't realize that there are those limitations in there, and unless the contract takes care of those limitations, you can get caught within them. So ironically, they're adding an additional insured for protection, and yet within that additional insured endorsement, it has language that allows the third party to get out of paying it. And that's not what we want. So not only are we verifying the certificate of insurance, we're verifying and triggering, activating the actual coverage. And once again, that's going to benefit all the stakeholders in the process, all of the people in our company, as well as our bottom line.